Did you know that improving your credit score could unlock better financial opportunities, better loan rates, and even higher credit limits? Want to know how to boost your credit score fast and efficiently? In today's video, I'm going to share 8 proven tips to help you improve your credit score quickly. These tips have worked for me and countless others, and with just a little consistency, you'll see real results. Whether you want to qualify for a mortgage, get approved for a top-tier credit card, or simply build better financial habits, these tips will help you get there faster. Let's get started. 1. Always pay your credit cards and loans on time. One of the most important factors in building and maintaining a good credit score is making sure you pay your bills on time, especially your credit cards and loans. Late payments can significantly hurt your credit score, and they stay on your credit report for 7 years. Even one missed payment can drop your score by several points. Here is a pro tip that if you're worried about missing payments, set up automatic payments for at least a minimum due. This ensures that you never miss a payment, and it helps you avoid any late fees or interest charges. Paying on time will gradually build a solid payment history, which makes up 35% of your credit score. If you ever find yourself unable to pay the full balance, paying at least a minimum will help keep your account in good standing. But paying the statement balance in full every month will prevent high interest from accruing and will show your creditors that you are financially responsible. 2. Keep your credit utilization below 10%. Credit utilization is a major factor in determining your credit score, and it accounts for about 30% of your FICO score. This ratio is calculated by dividing your current balance by your credit limit. Keeping your credit utilization as low as possible is crucial to maintaining a healthy credit score. Try to keep your utilization below 10%, or ideally in the low single-digit range. This demonstrates that you're not overly reliant on credit, and that you're using your available credit responsibly. For example, if you have a $5,000 credit limit, aim to spend no more than $500 at any given time. The lower your utilization, the better it is for your credit score. Even though some fluctuations are normal, consistently keeping your balance low will gradually improve your score over time. 3. Don't miss any payments, even if it's just a small amount. It's easy to assume that missing a small payment here and there won't hurt your credit score, but the reality is, it will. Every single payment counts, even if it's for a small amount. Missing payments or being late can seriously impact your credit score, and a single late payment can stick around for 7 years. Set reminders or automate your payments to avoid this. This simple habit ensures that even if life gets busy, you're never at risk of missing a payment. If you miss a payment by accident, make it a priority to pay as soon as possible to prevent it from being reported as late. The more payments you make on time, the better your payment history will look, and this will positively influence your credit score. 4. Start building credit early. Building a good credit history early in life can make a huge difference down the road. The longer your credit history, the better your credit score will be. This is why it's so important to start building credit as soon as possible, even if it's just with a small credit card or a small loan. The earlier you start building credit, the more time your credit age has to grow, which is an essential factor in determining your credit score. Even if you're just starting with a student credit card or a secured card, getting the ball rolling now can put you on a better path toward achieving a higher credit score. It's also important to maintain your oldest accounts. The longer your accounts stay open, the better your credit age will be, which positively impacts your credit score. Avoid closing old accounts because they help to establish your credit history and make your average credit age stronger. 5. Spread out new credit applications. Every time you apply for new credit, a hard inquiry, also called a hard pull, is made on your credit report. This can cause your credit score to dip slightly. However, it's important not to be discouraged by this. This dip is temporary, and your score will recover as long as you continue to maintain healthy credit habits. Spread out new credit applications over time to avoid a sudden drop in your credit score. If you apply for multiple cards or loans within a short period, the impact of each inquiry adds up, potentially hurting your score more than if you spread them out over several months or years. Instead of applying for multiple credit accounts all at once, space them out every 3 to 6 months. This way, the hard inquiries won't accumulate, and you can build a positive payment history with your new credit. 6. Diversify your credit mix. Credit mix makes up 10% of your FICO score, so it's important to have a diverse range of credit types. This could include a combination of credit cards, installment loans, and mortgages. A good mix of credit types shows lenders that you can manage different forms of credit responsibly. That being said, don't rush to open accounts just to diversify. Only open new credit accounts when they make sense for your financial situation. For example, if you had a credit card for years, consider adding an auto loan or personal loan to diversify your credit mix. Remember, diversification helps your score, but it's not something you need to actively seek out unless it aligns with your financial goals. Focus on making timely payments and keeping your utilization low, which will help improve your score regardless of the credit types you hold. 7. Keep old accounts open. The longer you had a credit account, the better it looks on your credit report. Old accounts help your credit history, and closing them can negatively affect your score. If your old credit accounts have no annual fees, keep them open to benefit from the age of credit that contribute to your score. Even if you don't use an old account anymore, it's wise to keep it open unless there's a good reason to close it. Some people mistakenly close accounts that have no annual fees, thinking it will help their credit score, but it actually hurts them by reducing their credit history length and increasing their credit utilization. If you're no longer using a credit card, keep it open and use it occasionally to keep the account active. This helps improve your credit history while contributing positively to your score. 8. Avoid maxing out your credit cards. Maxing out your credit cards or using too much of your available credit can significantly damage your credit score. If your credit utilization rate is high, it signals to lenders that you may be relying too heavily on credit, which can make you appear financially unstable. Try to keep your balance under 30% of your credit limit, but aiming for 10% or lower is ideal. Here is a pro tip. Set a spending limit for yourself to avoid accidentally maxing out your card. Regularly check your credit card balance to ensure it stays within a manageable range. If you do find yourself approaching your credit limit, try to pay it off before the statement date to avoid any negative impact on your credit score. Using only a small portion of your available credit each month shows lenders that you're responsible and helps keep your credit score high. That's it. Guys, follow these 8 tips and you'll see a marked improvement in your credit score over time. Building a great credit score isn't something that happens overnight, but with consistency, patience, and the right strategies, you'll be well on your way to achieving your financial goals. If you found this video helpful, please give it a thumbs up and don't forget to subscribe for more tips on managing your credit and improving your finances. And if you know someone who could benefit from this information, don't hesitate to share the video with them. Thanks for watching, and I'll see you in the next video.